One of the reasons why we're having this session is because some people are interested in how to evaluate real estate funds, but really it's because of people like me that meet others all over the place that say, I've got this really cool real estate investment. Will you pass it along to Meghan and check it out? And so and some of you are guilty of doing the same thing, but there's so much more that goes into it besides saying, hey, Meghan, here's the deck. Will you take a look at it?
I mean, I just go by the color scheme, so that's my yes or no.
Happy hour is after this session. It will be in the other room, sort of back behind the main stage. So maybe some people are already there.
I just want you all to know I did try to get past cocktails during this session as an incentive, but I was not successful. But we can run down the hall when we're done here. It'll be good.
So how effective is it for myself, others, to hand you a marketing deck and say, will you evaluate this? I was hoping it was going to be a topic on golf where I knew more than you did, but unfortunately it's real estate funds. So
then I would be moderating and you would be. Yeah.
Exactly. So how effective is it to say, hey, Meghan, I came across this person. They're sharing me their newest investment deal. Take a look at it.
I mean, it's a good initial way to look and get a quick synopsis of whether or not something could be interesting. I just say you should assume, and this happens a ton, right? A friend shows you something, or at a country club, everyone's going into a deal. You just go in assuming it's going to look amazing. You have never seen a marketing deck that did not look amazing, right? That the numbers weren't really eye-popping and exciting. It's just the nature of it. They wouldn't be showing to you if they hadn't found a way to make it look really good. When you go under the hood a little bit, and sometimes you can tell this from the actual deck, sometimes you have to get more information, but there's a lot of assumptions that go into those percentage return numbers, 20% IRR. And so a couple of things to ask or look for is a big one is the time frame that they're looking at. It's a lot easier to make a big return show up on the page if you assume that you're going to sell it really quickly. So let's say you go in, you do a repositioning real quick, you lease it up, and then you're going to sell it in 2 years or 3 years. That could generate more easily a high return versus, well, what if it takes a little bit longer? What if it takes 4 years, 5 years, 6 years? What if you're in a challenging environment to sell? The return drops real quick on the spreadsheet when you start to extend out the time frame that you're looking at. How aggressive or conservative is that manager being on the potential, on the growth of the income for those properties, on the growth of the expenses? That's a huge one right now, just insurance costs and things like that. And so delving into a little bit more than just the number looks good, but how do they get to that number, I think is a big deal. The other one that's a quick, easy one to look at real fast is the fees. So with a real estate fund, if anyone listened to Stacy and Kevin's session, they were talking about pros and cons, right, of having owning it yourself, the real estate, versus having a fund. One of the there's a lot of pros, I think, to a fund structure. One of the negatives is there's an extra layer of fees. How reasonable those fees are matters a lot. So usually there's some type of management fee, and then there's a percentage of the profits that the manager gets. The first thing is, when do they get those profits? That's important, right? Because what we want to see usually with real estate funds we invest in is it's fine for them to make a management fee, keep the lights on, be able to pay their staff, but really where most of their profit should be on the back end, right? If once they're successful and the investor's successful, if they get their piece of the profits, then nobody minds that, right? Versus upfront, them getting an acquisition fee and a fee to set up the financing and getting paid all along the way. There's a lot of that in some of these real estate decks. Last thing I'll just say is how much of their own money are they putting into it? People behave differently when it's their own money versus investor money. So that's something too that a good manager who's invested in it will often put that in the deck, be like, hey, I'm putting X percent, or the general partner is a big percentage of this fund.
So when you're thinking about alignment of interest, two of those key points is not only do they have their own money invested in the fund, but also beyond that, at what point do they participate in the return profit?
Exactly. And so I don't mind them sharing once we as the investors have gotten paid, but you don't want that to be too early. The other piece is sometimes your friends and family deals, that almost implies you're getting a discount or a special deal. Often those deals have really egregious back-end fees. I've seen the manager taking 50, 60, 70% of the profits. And it's because it's small, and it's because it's their friends and family, so they can get away with it. So it's just, that's not uncommon, and that's not even crazy. That's how some of those are priced. Institutional managers, it's going to be more 15 or 20% of the profits, which might have sounded high before I said 50 or 60, but now seems so reasonable.
So we can agree that a marketing deck is meant to look nice, because you've yet to see one that did not. So even with those fees and all these things that she's evaluating, the numbers still look really, really good. How do you evaluate the downside and the better understand the stress tests of these different funds to help you move forward?
Well, every now and then a manager will put a stress test in their marketing deck, which I love. That it just tells you about the kind of person they are. But most don't. Most are just going to tell you this is the rosy scenario because, again, they're marketing, they're trying to sell it. I think that's where you probably have to go beyond the deck, and you have to either have manager conversations, get their models and their spreadsheets, and you really have to stress test it. But ideally, again, they do that for you. Ideally, you're dealing with somebody who's thinking about, hey, this is what we think is going to happen, and we're excited for all these reasons, but what if we're wrong? What if the market changes? What if things shift faster than we were expecting? What's going to happen then? And you want to be able to see what happens to the numbers. Spreadsheets can be fun and dynamic. We are not going to geek out on Excel today, but if you can change the percentage growth rate, right? What does that do to the end number? If all of a sudden they can't refinance in year 3 like they were planning, or interest rates don't drop like everyone's hoping for, what does that do to the end numbers? And there's a group we work with. I think they're actually speaking right now on the investment stage. Don't leave though. Don't leave. KCB Management we've been with for over 2 decades, and one of the reasons why I actually think they've been so successful in their real estate funds is because they start out going in and they basically stress it up front. So they want to know that if things go sort of not according to plan, that they're still going to hit their return numbers. Because of that, they pass on a lot of deals. They say no to a lot of things, but when they do it, there's just a big cushion built into it. So they've had really good results over the years.
And you also talked to me about manager reputation and references as a big key point that you sort of go into as well. I never really thought about that. I just like the numbers on the deck. 25% returns.
25 is great. Look, I think there's been a lot of we haven't actually had a lot of real estate cycle other than what we're going through now. It's been a while before that, right? 2008 was the time before that, and then there was a fair distance before that for like real estate challenges. Ideally, you're with a manager, and this manager has lived through challenges, right? Because if they haven't, it's really tough. They're not going to even know what to look for and what to stress test for. So being able to even talk to former investors of theirs, and that doesn't mean, by the way, they did everything perfectly in previous funds or they didn't have issues. How did they deal with those issues? It's actually really hard to underwrite a manager who's either newer or who never had a problem, because you're like, are you lucky or are you good? And versus the ones who actually had a challenge, worked through it, came out the other side, and their investors felt like they were communicating clearly and that they were doing the right things for investors all throughout the process. That can be a very powerful reference, again, even if their track record's not perfect.
I mean, we had a real estate lending group come to the office last week and talk to us, and he had said that you guys sort of dated for 2 years before you decided to invest with them. You reached out to a lot of other people in the industry and say, do you know these people? Are they trustworthy? Do they do a good job? What's their reputation? How have they handled issues that they've had to deal with in the past? You also take that into consideration as well.
Yeah, I think we have great networks of other firms that are either like us or different groups who like different kinds of alternative investments. And so it's great when someone gives you a reference. I don't know if everyone's known this or has noticed this as well, is when you get a reference, it's always positive. It's amazing. If you can find your own references, sort of, back channel, finding out how other people who know this group, you get a lot more information, and sometimes it's positive and sometimes less so.
How many real estate funds do you get pitched in a given year?
Many. Right now, it's crazy. Actually, there's a lot right now. It's at least a couple every single week. There's just a lot. There's a lot of people. The fun thing about them now too is this is the pitch. It's like, cap. Does everyone know what cap rate is? It's like a cap. It's like the percentage of the yield without leverage on a property. So in theory, when you buy, you want a higher cap rate, right? Because you want to buy it's a good yield. And if the price goes up a lot, your cap rate drops, your percentage. So they'll come and they'll be like, you guys, you can buy this real estate property for a 5 cap rate right now. It was 3.5, 2 years ago. Like, look at that. Isn't that amazing? And it's like, but no, like it's still interest rates. You're going to borrow at 6 or 7. Like, it doesn't make sense. So a lot of managers now too are looking at kind of, it's very much relative, like, to where it was, and they're so excited, and so they're just pushing content. But I like to say this, I'm like, it's great to look and say, I hope that rates go down, but hope is not a strategy. And so you have to have it where it works without that happening. And then if it goes down, great, everyone's excited. But there's a lot of those decks to watch out for where they are assuming rates drop, and they're assuming that is a very important part of the strategy for making the returns they're targeting.
Now, I know we've been investing for real estate for a long time, and there's a lot of people that know that Morton does that. And so we get pitched all the time. People I meet go, oh, hey, can you get this in front of Meghan? You know, I really think that we've got a good opportunity. So it happens all the time.
And my answer is like, is this really helpful, Chris? Do you really need me to?
They took me to a nice golf course. How are funds and groups that you work with or you evaluate, how do they negotiate other fees or lower costs that end up being beneficial?
Yeah, so back to the idea of, again, a fund costs you more. There's definitely more fees embedded in it. I will say, though, I've seen it firsthand where those managers, when this is all they do every day, it's very different than an individual who's sitting there making the calls, right? Or who finds a deal. A broker brings you a couple of deals for a 1031 exchange and you pick which one you're going to buy. These guys are in there. They're getting shown a lot of off-market transactions. They're buying hopefully at much lower prices. They're getting shown more opportunities. So that's one thing is I just think they have more choices and better buying options when that's what they do all day, every day. They're able to, I've seen now numerous times, insurance costs have become a really big issue in the industry. And so when you have many properties that you're managing, you're sometimes able to negotiate better rates across, a carrier, better property management costs if you're using the same property management company. And so some of those benefits that get passed on to investors, I think, help offset at least some of those fees.
Does size matter as it relates to real estate funds?
I tend to prefer smaller, more mid-sized managers just because I think sometimes they can get more of those off-market or under-the-radar transactions. It's tough when you have a certain amount of dollars to deploy, billions of dollars, you just kind of need to buy the market. Like you can't sit there and be selective and say yes, no. You really need to put money out fairly broadly. And so I prefer groups who can be more selective, so that one might be a smaller size. It might also just be the way they're structured. Again, KCB I used as an example before. They put big amounts of their own money into every deal. So you know what? If the deal's not right, like they don't want to put their own money in it, they're not going to put client money in it. So that sweet spot, that mid-size, I think can be a real sweet spot for some managers.
I mean, they've even shared in the past where, the unfortunate life events creates opportunity for them because they play in that middle market, call it $30 million to $100 million transaction size. They had a couple that was getting a divorce, an apartment building in I think Chicago. Don't hold me to that, although she's going to. And they were able to kind of come in, find this opportunity, and immediately lower costs and operate it more efficiently. That created a much better opportunity.
Yeah, when someone goes and runs a process and brings in brokers and you get one price, and then if something's off market, someone needs to sell for a non-economic reason, right? Because the property's doing fine. It's not a problem with the property. It's an issue with the seller. That's where there are opportunities created. And so I have not seen currently in this environment, even though we've heard a lot about real estate prices falling, I really haven't seen amazing opportunities where I'm like, oh my gosh, I have to have that. I'm excited. I want that. The one-offs, though, have been really good. Again, the funds being able to pick off things where you're like, oh, that's a great deal. That's a great property. It's just, you have to be selective and the sizing has to be right. Because again, if they had $1 billion to put to work, putting $10 million equity check into a property wouldn't move the needle. That one you're mentioning, it's small. It was like a small apartment building. And I think the size of the equity check was about $10 million.
I'm hoping it was in Chicago, so I can say.
We're just going to go with that. That sounds fine.
This is my favorite part of the session because this is something that Meghan is extremely passionate about. What annoys you the most about real estate funds?
That's what we're going with before cocktail hours. What pisses me off? So there's a trend and something for everyone to look out for right now, which is driving me a little nuts because if anyone's listening to me talk about credit, I care a lot about the fund structure. So we have the investments, but then what's the framework around it? How does liquidity work? All those different things. And when you have a loan portfolio, like if you're lending on real estate, having an open structure where you can put money in, take money out at different intervals, it makes a lot of sense. You get that same structure, and they're trying to make that structure work now. The big guys for equity, so they're going to now go and put equity, long-term illiquid assets into a vehicle that people can buy in at, sometimes daily, all the time, and that people can exit, every quarter. And if anyone thinks that sounds like a mismatch, you are right. But it's really challenging because the biggest thing that bothers me about it is actually the valuation piece. So what price are we buying and selling at when we do it? And by the way, if you're in big apartments, you can get reasonable data and comps on the levels. But some of these, again, literally you can buy it every single day. And so if you think that the price that they're making up from day to day, it's amazing how it's super consistent. It just kind of goes like this over time. And so I think the valuations are a real problem on these open-ended structures. The problem is they're more friendly, right? So if I come to you and I say, hey, I've got this vehicle, it's just a 1-year commitment, and then you can get out every quarter after that. That sounds pretty good, right? If I say, hey, we're going into real estate equity, so this really needs to be a 10-year commitment. You need to think of this as long-term. This isn't quick in and out money. It's going to take you a little bit to be invested. You're going to get a K1. That doesn't sound as appealing as the super easy thing that you buy into. But if that long-term 10-year thing doesn't make sense, if that doesn't make sense for you, and some people it doesn't, probably real estate equity doesn't make sense. It doesn't make sense to like try to now cram it into this vehicle that seems more investor friendly, because ultimately there's going to be real challenges with it. By the way, the other piece that's going to be challenging with it is when people want out, they're actually set up the right way. So that they're set up so that they're going to limit the amount that wants out. In any given quarter, they're going to be like, nope, too many people want out. We're only letting a little bit out. And that's good. They're not going to have to fire sale assets. But I assure you, there are going to be a lot of people in those funds who didn't understand that going in, that could happen. And they're going to be really unhappy. And it's a kind of your classic run on the bank scenarios, right? Where everyone wants out. And then it's not so much a problem with the assets as much as the fund is sort of deteriorating. And so I'm watching these assets, and they're just gathering so much money, like so much money coming into them because they're easy. It's also you click a button, you buy it, kind of thing. Easy does not necessarily mean good. So.
And you're not naming any names, but I will. So Blackstone is one of them. The B-REIT investment that they have. Again, they've raised several $1 billion to go buy real estate. If you raise several $1 billion in a short period of time and you're paid to put that money to work, what are you going to do? You're going to go buy a lot of stuff you may or may not like. But then the selling point is, oh, you can get out quarterly. And what Meghan's telling you is that in times of heightened, issues, that quarterly is a facade. It is not real, because you can't just click a button and create liquidity on a piece of real estate. Because if anybody's ever tried to buy a piece of real estate, can you do it in 24 hours or 2 minutes? No, it takes a lot longer than that.
I have a friend who's invested in B-REIT, and to give you a fine point on this valuation issue, at the end of, I think it was last year, their marketing rep came to them and they were like, you should put more money in the fund. Real estate is down like 20%. He was like, oh, really? Okay, like interesting. So he asked me, what do you think? Real estate's down 20%. Should I put more money in? And I said, what's their fund down? And their fund was up 2%. And I'm like, something is not connected, right? So they're speaking out of both sides of their mouths, and it's again, I love the idea of being able to democratize some of these investments for more people, right? We're really passionate about, we do a lot of it. It's just, if you're going to be in long-term illiquid assets, it's got to be structured the right way.
Meghan, I enjoyed this conversation today. I know we only have a couple minutes left, but just to recap it before anybody might have any questions. When you're looking at a marketing deck, it's going to look good, because if it didn't look good, Meghan actually might want to talk to those people and figure out why. Figuring out the alignment of interests is really key. Are they investing their own money alongside with you? And at what point do they participate in the higher profits or higher fees? But then also, what's their experience like, and what are the assumptions that go into the marketing deck? Because hoping for lower rates so that way everything works out is definitely not a strategy. They need to be able to stress test this and show you how over time, if they're wrong and interest rates stay high or even go up, or other costs like insurance. Insurance is incredible. I have a client that owned an office building over here, and within a couple of years, his fire insurance went from $30,000 a year to over a couple $100,000 a year. So all of those assumptions that we think look good in a marketing deck can quickly get challenged. So there's a lot more that goes into it than just looking at fancy numbers on a marketing deck and really nice colors, to Meghan's original point where she says yes or no.
I like green.
Yeah.
No red, just green. Yeah.
Before we end, is there any questions that anybody has in terms of how Meghan looks at investing in real estate or real estate funds and tries to pick them apart?
You can't put questions right before cocktail hour. Like that's a tough one.
I know. I think we made it out on time. Thank you, everybody. Really appreciate it.